Krispy Kreme has been a household name for decades, known for those irresistible glazed donuts that melt in your mouth the second they hit your hands. But behind the sweetness lies a company fighting to regain investor confidence and rekindle growth momentum. The company's third quarter 2025 earnings gave investors something to chew on. A mix of progress, operational adjustments, and cautious optimism. In the third quarter of 2025, Krispy Kreme reported revenue of around $405 million, representing a year-over-year increase of about 5%. While that might not seem spectacular compared to high-growth tech companies, it's an encouraging sign of resilience in a consumer environment that's still battling inflation and shifting discretionary spending habits. What really stood out is the company's gross profit margin, which expanded slightly thanks to operational efficiencies and a greater focus on higher margin sales through its hub-and-spoke model. This model, essentially the strategy of using large production hubs that supply fresh donuts daily to smaller retail outlets and third-party partners, continues to be the backbone of Krispy Kreme's turnaround plan. It has allowed the company to increase its daily fresh delivery points across major retailers like Walmart and Target, boosting both visibility and accessibility. According to management, the goal remains to make Krispy Kreme donuts available within 20 miles of nearly every customer in North America. But even with progress on logistics and brand reach, profit growth is where investors are laser-focused. The company's adjusted EBITDA came in at roughly $42 million, slightly ahead of expectations, while adjusted earnings per share remained modest but positive. Operating expenses are still a concern, driven largely by supply chain costs and marketing expenses tied to expanding partnerships. The bright side, however, is that the company reaffirmed its full-year guidance, which signals confidence that cost control measures are beginning to stick. Another development that caught attention is the growing success of Krispy Kreme's collaboration with McDonald's. The company began testing selling fresh donuts in select McDonald's locations, and the initial response has been overwhelmingly positive. The nationwide rollout could be a potential game changer, dramatically increasing volume without the same level of capital expenditure required to open new stores. This partnership alone could serve as a key growth catalyst in 2026 and beyond. From a fundamental standpoint, Krispy Kreme's balance sheet remains relatively stable. Net debt sits near $700 million, a level that's manageable given its consistent cash flows, though investors are watching for progress on debt reduction. Free cash flow improved modestly in Q3, signaling that operational discipline is paying off. The company also continues to pay a dividend, offering a small but steady return to long-term holders. Looking at the technical side, the stock has recently been hovering around the $13 to $15 range, bouncing off support near $12. This could indicate a bottoming pattern forming after months of steady decline. If momentum continues, we could see a breakout toward the upper teens as earnings visibility improves and investor sentiment shifts more positive. The RSI is trending toward neutral territory, suggesting the stock may still have room to move higher without being overbought. From a SWOT perspective, Krispy Kreme's biggest strength remains its powerful brand and product loyalty. The weakness lies in its relatively thin margins and dependence on consumer spending habits, which are sensitive to inflationary pressures. Opportunities include expansion through third-party distribution, international growth in markets like the UK and Asia, and digital order growth through delivery apps. The primary threat continues to be competition, both from local bakeries and global quick-service chains entering the breakfast and snack segments. So, what's the takeaway here for investors? Krispy Kreme is not a high-flying growth stock, but it's a turnaround story with credible momentum. Management's focus on operational efficiency, strategic partnerships, and disciplined expansion is beginning to show real results. If the McDonald's collaboration scales effectively and margins continue to expand, Krispy Kreme could deliver a sweet comeback story for patient investors. Given the steady improvement in fundamentals and technical stabilization, this stock looks like a modest buy for long-term investors seeking a blend of brand strength and turnaround potential. And as always, if you found this breakdown helpful, make sure to hit that like button Subscribe for more in-depth stock analysis and stay tuned for our next deep dive into companies shaping the future of consumer markets.